So the topic today is a deep dive into the current state of the market, and it really is going to focus on what Neil was just discussing, which is we've seen some very intense selling pressures up until today, where we're seeing a nice rally today. But really, starting from the beginning of the week, we've seen a broad sell-off across all asset classes. And when I mean asset classes, I mean stocks, credit. What is credit? Corporate bonds. When you hear someone talk about credit, they're talking really specifically about corporate bonds. We've seen big declines in commodities. Gold, silver completely collapsed this week. Copper, even oil, even though oil has been having a nice run up because there's concerns that the U.S. may strike Iran soon, which has been giving a big bid to oil. We've seen oil come off a bit this week as well. And as we've discussed, and Neil just said, there's been no bad economic data. There's been no major negative earnings surprises. Corporates are releasing their earnings reports for the fourth quarter of last year, and the earnings have, for the most part, beaten expectations. So this negativity seems to be entirely sentiment driven and almost irrational, right? Almost irrational. But let's really dig in to what's going on to see if we can better understand why we've seen this negative shift in sentiment. So, for sure, there is a theme that is dominating financial markets, concerns over AI. And we're going to return to that theme because it's important to understand it, because there are concerns about AI that has led to this downturn in sentiment. But there's something else going on here as well, and we've discussed it, and it has to do with Kevin Warsh. And on Wednesday, I sort of dismissed that this ongoing sell-off was still related to Trump's nomination of Kevin Warsh to be the next Fed chair. But as I've thought about it more and really observed the way this market has sold off and what assets in particular have sold off the most, it's increasingly clear to me that the nomination of Kevin Warsh is partially responsible for this negative swing in sentiment. Now, when I say let's look at some specific assets, let's get into that. Certain assets have sold off more than others, and that's led me to conclude that the presence of Kevin Warsh at the Fed beginning in May or June, that's when he'll officially take over the Fed as chair in all likelihood. Um, we've seen certain asset prices get hit hard more than others, and that's led me to conclude that Kevin Warsh is the reason. Now, let's begin with Bitcoin. Bitcoin was created, according to the proponents of Bitcoin, to hedge against a dollar decline. That is to protect investors against a major decline in the dollar. And the dollar is thought to be the reserve currency in the world, the currency that everyone in the world trusts as a stable store of value. The dollar is accepted everywhere as the most reliable method of payment. But proponents of Bitcoin said that the future of the dollar as being the most stable currency in the world is increasingly questionable and is increasingly fragile. Why is that? And this is something we've discussed. We discussed it a few days ago, but I want to review it. Large government deficits, a bloated government is leading to excess borrowing, right? When you have huge deficits, you've got to borrow that money to cover those deficits. All that borrowing is leading to ballooning government debt. And many people believe that this debt simply won't be serviceable. The government won't be able to pay it off without printing money, right? There won't be enough taxes to cover those deficits. The government has no interest in cutting spending. So you're going to increase debt larger and larger. The debt will not be able to pay it off. So the only way to pay that debt down would be to print money. And if the Fed is the one that prints money, right? And if they print money, this will cause a major depreciation of the dollar because when you flood the world with printed dollars, the dollar will lose its value, and that is known as debasement, debasing the dollar. And Bitcoin was really the initial debasement trade. If you were to go back a few years ago when the proponents of Bitcoin really started to pump Bitcoin and say, this is the place to be, this is the asset you want to hold, it was fear of debasement of the dollar. And the idea was that Bitcoin would simply replace the dollar as the most trusted currency in the world. Now, why was Bitcoin believed to be so trusted, so reliable? Well, it can't be printed, right? It gets created by some algorithm. The algorithm can only produce so many Bitcoins, and ultimately that supply of Bitcoin will be capped. It'll be limited. So Bitcoin is finite. Yes, it will increase in supply up to a point, but then it'll be capped. And the dollar, you can just print and print and print and print as you can with any other currency in the world, but you can't do that with Bitcoin. So Bitcoin was viewed to be a stable asset. Ultimately, it would be used for transactions and replace the dollar. But Bitcoin peaked last year in October at around $126,000 per Bitcoin. That's where it peaked. And since that time, it began to trend down. And actually, since the time that Bitcoin peaked until yesterday, Bitcoin was down over 50% from that peak. It hit $60,000 early yesterday evening. It's jumping a bit today, but it was down over 50%. So while Bitcoin was trending down again since October of last year, the notion of debasement of the dollar really began to intensify. And it really began to intensify, especially when President Trump had the Department of Justice open up a criminal investigation against Jake Powell, the chairman of the Fed. And with that criminal investigation, the fear that the Fed would lose its independence and become subordinate to the government, that fear intensified. Right? So people thought, yeah, maybe one day far out, the Fed will do whatever the government wants. And if the government wants the Fed to print money, it'll happen. But we're still a ways away from that. But when Trump started attacking the Fed and the Department of Justice opened up this criminal investigation, the idea that the debasement could come sooner rather than later, that idea intensified. And what happened? The flight away from the dollar skyrocketed. We saw the dollar depreciate against foreign currencies, against the euro, against the pound. Those of you in our currency program know that very well. Now, interestingly, Bitcoin during this time period, where the dollar debasement theory had reached a peak, Bitcoin was continuing to trend down, to trend lower. So Bitcoin wasn't living up to its reputation as the stable alternative to the dollar. So instead of people who wanted to play this debasement theme, instead of buying Bitcoin, they began to rush into other non-dollar assets, right? We mentioned foreign currencies, but mostly they started buying gold and silver, right? Not Bitcoin because Bitcoin wasn't working anymore. Now, silver is an interesting one. Why did silver really start to take off? You would just think it would be gold, but silver is seen as a less expensive alternative. And because it's less expensive and gold has been on a run now for well over a year, the thinking among many hedge funds and others, the thinking was maybe silver has more upside. So you saw investors pile into not only gold, but silver. And over the last, 6 weeks or so, silver went up far more than even gold. So every day over the last few weeks, gold and silver were galloping higher. Now, by the way, debasement, a weakening dollar, isn't such terrible news for the stock market either. Why? Because companies produce earnings. And if you're worried about a dollar depreciation, you're also worried about higher inflation. Why higher inflation? Because as the dollar weakens, the price of imports goes higher, and higher import prices cause inflation to go up. Well, companies produce earnings, and their earnings are linked to inflation, right? If inflation goes up, companies will increase more for their products. So if inflation is going up, corporate earnings are also going to go up. So people were also comfortable buying stocks. So gold, silver were the, top two performers, but equities, stocks, the stock market was doing pretty well also in recent weeks. But something changed on January 30th. That is the day that President Trump named Kevin Warsh as his nominee to replace Powell when Powell's term expires at the Fed in May. And suddenly, with Kevin Warsh now at the Fed, the idea of dollar debasement is seen as much less likely. Why is that? Because Kevin Warsh has been a huge critic of money printing, right? We talked about this on Wednesday, but a quick review. The Fed in 2008 printed a lot of money to get us out of the financial crisis. Kevin Warsh was at the Fed at that time. He supported that money printing initially, but by 2010, he started to criticize it. And he resigned from the Fed in 2011, and he continued to criticize that money printing. And that money printing extended all the way until 2014. And Kevin Warsh was a big critic of it. Now, by 2014, the Fed's balance sheet grew to $4.5 trillion dollars. It had been $900 billion dollars before the great financial crisis. So how does that balance sheet grow? Well, the way the Fed prints money is by buying government bonds. And when they buy government bonds, they put money, they buy it with cash, and that cash goes into the banking system. And the balance sheet grows by more and more treasuries being put on the Fed's balance sheet as they buy those government bonds. And then after COVID, which happened in 2020, we had another major money printing exercise by the Fed, and the balance sheet went all the way to $9 trillion dollars by 2022. So it went from 900 billion in 2008 to $9 trillion dollars. And what is the growth of that balance sheet? It's government bonds as well as home mortgages. That's what the Fed was purchasing and putting huge amount of money into the system. Now, Kevin Warsh is very much against this money printing because he believes that money printing makes it very easy for the government to continue to run excessively large deficits, right? If the government knows that the Fed is always there to buy their bonds and keep interest rates exceptionally low, then they can run large deficits at a very low fee, at a very low price, because the central bank, the Fed, is there to finance them. Now, Kevin Warsh is saying no more. We're going to begin to shrink the size of the balance sheet. We're going to actually maybe sell treasuries, maybe we'll just let those treasury bonds as they mature roll off the Fed's balance sheet, but we're not going to be in the business of funding government deficits any longer. Again, if anyone wants to review, I went into a deep discussion of this in our class last Wednesday. So if you want to review some of the details of how all this works, you can listen to that class again. But the bottom line is the market began to sense that under Kevin Warsh, this notion of dollar debasement, it's not going to be there. It's much less likely to happen. So how did we see this play out on the market? Everything that investors were buying to protect themselves from debasement collapsed. So number one, silver, which was like gold on steroids, because that silver started to go up it was like just skyrocketing. Silver collapsed. Gold also got hit very hard. And of course, Bitcoin. Bitcoin, even though it wasn't the go-to play for this latest leg of the debasement trade, still the whole reason why Bitcoin was created in the first place was to protect against debasement. And if there's not going to be any debasement, why should I own Bitcoin? So Bitcoin began to unravel as well, even further. Now, stocks also got caught up in this. Okay. And before we get into the stock market, I just want to mention one thing. The only piece of the puzzle that I don't, I didn't initially quite understand, but I do now, is the dollar. If the dollar is not going to be debased, why aren't we seeing a massive dollar rally? We should be seeing a huge, huge dollar rally. Now we've seen the dollar come off its lows, right? It reached it broke, it broke like 119 at one point against the euro. It fell below 118. So we saw the dollar rally a bit, but not nearly to the extent that I would have expected. The reason for that is because Kevin Warsh, while he says he wants to stop bailing out the government, he also says he wants to cut interest rates pretty aggressively. And I think that's the reason why the dollar hasn't rallied more. It's because the market understands that, okay, debasement, the threat of debasement is over, but Kevin Warsh still wants to reduce interest rates. And we know that typically, if a central bank is cutting interest rates, everything else equal, that currency tends to weaken against other currencies. So the dollar hasn't weakened, it's strengthened, but it didn't strengthen nearly as much as it might have if Kevin Warsh weren't a fan of cutting interest rates. So that explains a little bit why the dollar hasn't strengthened more. The question is, when does the bleeding stop for Bitcoin and gold and silver, if debasement is the whole reason for owning them? Well, I would think that if Kevin Warsh really activates his plan and shrinks the Fed's balance sheet and sends a very clear signal to the government that we're not going to make it easy for you anymore to run big government deficits. You're going to have to get your deficits under control. You're going to have to stabilize the government debt. If that really comes to pass, I suspect these debasement trades, Bitcoin, gold, and silver, have a long, long way to decline. And the dollar should have a long way to rally, even though he does want to cut interest rates, because this debasement idea has been so entrenched, so ingrained in the minds of many investors and hedge funds. If that gets wiped out and debasement isn't a concern anymore, you'll see a good dollar rally. Now, what about stocks? Why did stocks get hit so hard? Because people weren't initially, no one was buying stocks because uh, for debasement reasons. yes, stocks are decent protection if there is some debasement. They'll hold up reasonably well. But, we didn't see this massive run up the way we did in gold and silver. So why should stocks get hit in this big sell-off? And the reason is essentially margin calls. What's a margin call? Well, when investors buy things like Bitcoin and gold and silver, oftentimes they will borrow to purchase those assets, those commodities and those assets. They'll borrow money. They'll borrow from brokerage houses. They'll borrow from Wall Street, banks. Well, when the assets they buy drop below a certain level, then these trades are no longer profitable. And the banks and the lenders will tap the investor on the shoulder and say, you're now down on your investment. You need to sell because you need to pay me back. So these investors, in order to pay back the lender, they won't only sell Bitcoin and gold and silver, they'll also start to sell stocks. And that's what we've seen. We've seen massive margin calls go through. And it causes forced selling in the stock market. And ETFs get sold, stocks get sold. So it causes this chain reaction across all financial markets. Now, that basically helps us understand the Warsh effect, the effect of Kevin Warsh, and why the market got hit because of Kevin Warsh, and why it started with gold and silver and Bitcoin, and then it spread to the stock market. But that's not the entire story. There is an important AI component. And if you listen to Bloomberg News, or if you're listening to CNBC, or if you're reading the Wall Street Journal, you'll notice that they're not really focused on the Kevin Warsh effect. They're focused on the AI theme. And that's what I'm going to get into now. There are three major concerns associated with AI right now. And these three reasons are also part of the sell-off that we've seen. Number one is there is deep concern that there is overinvestment by tech companies in AI. And I'm just going to make it very clear for you. 12 months ago, Amazon, Google, Microsoft, and Meta, formerly known as Facebook, those four companies combined plan to invest $350 billion in AI and related technologies. Now, that's a lot of investment, $350 billion. But if you look at their earnings reports, which just came out in the last few days, that number has increased to $650 billion of investments. So 350 billion was already a lot, but now they're planning to make investments of 650 billion in AI and related technologies. This is just a staggering sum of money. And the concern among investors is you guys are spending boatloads of money. How do we know that there is going to be a decent return on investment? That you're going to generate big returns? Maybe all this investment or a good chunk of it is going to be wasted, and you're going to have fairly unimpressive, mediocre returns on all this investment you're doing. Now, this concern has been with us for a long time. We had a lot of these conversations in 2005. Every time we'd have a wobble in QQQ, right, or SCHG, those are two heavy tech ETFs. we would talk about this theme. Investors are concerned that these companies are over investing in tech. Well, now they're investing even more in tech than they were 6 months ago. So the concerns are that much higher. So that's reason number one. It's just the unknown. And this question of will there be a decent return on investment, we're not going to know the answer to that for several years because we're not going to really know whether AI is as amazing as all these companies think it will be until a few years down the road. I suspect it will be amazing and even maybe more amazing than anyone thinks, but we won't know that for sure. So these concerns are going to be with us for a few years. And we're going to see, the market rip higher, and then a few weeks later, we're going to see tremors. That's just the world we're going to be living in for a few years. The second concern, the second concern is, and this one is brand new. This one hit this week. Well, that's not true. A part of this story hit this week. So the concern, which has actually been going on for a few months, is AI, artificial intelligence, is going to make much of the software company, what the software companies do, obsolete. A lot of software will be replaced by AI. And in some ways, this fear that we're experiencing right now is similar to the deep seek moment that we had last January, January of 2025. Does anyone remember DeepSeek? This was the Chinese AI company that would be a competitor to ChatGPT, to Grok, to Gemini, to all these chat boxes. The concern was that DeepSeek could do just as good of a job as these other chat boxes, but at a fraction of the price. And as a consequence of that, we saw AI stocks get clobbered. Nvidia dropped close to 20% in just a couple of days at the end of last January. So this concern that software companies will become obsolete has been at work actually for a few months right now. So we've seen software companies plunge. We've seen software companies down between 30 and 50%. But what was new this week, there was a new development this week that really caught the attention of tech investors, and it caused tech to get whacked. Anthropic, which is a very important AI company, it has new AI tools built for its chat box, Claude. Okay. I don't know. I've never used Claude, but it's a competitor to ChatGPT and Gemini. Well, Anthropic built new AI tools for Claude's co-work AI agent. Okay. It's an agent that is designed to handle complex professional workflows that many software and data providers perform that function now. So a lot of software companies took an additional nosedive because the thinking is these companies, the work that they do and they provide to businesses across America and across the world, their products are going to be obsolete because of Anthropic's new AI tool or tools. So this is new and again very similar uh, to the DeepSeek moment. Now, if you listen to some of the huge, the heavyweights in the AI industry, people like Johnson Wang, the CEO of NVIDIA, they say this concern is overdone, right? It will actually, the Anthropic AI tools and other AI tools, they'll actually enhance a lot of the work being done by America's software providers. Yes, there'll be some software providers that maybe don't survive, or their business loses a lot of market share. But by and large, the worry that these software companies will become completely obsolete, it's overdone. And today's snapback in the market, hopefully it lasts, is sort of an expression of, well, this huge fear. Perhaps it's a bit overdone. The final concern, I mentioned three concerns associated with AI. The final concern, and we discussed this one also on Wednesday, but you have all these AI companies, right? And they're all competing with one another. And competition is a great thing, right? It's one of the things we love about free markets. Competition makes everyone better. But when there's a lot of competition, not everyone wins, right? Not everyone wins, and there's some losers. Not only that, when there's a lot of competition, it reduces these AI companies' ability to raise prices very aggressively. And actually, maybe they even need to cut prices. So while lower prices is phenomenally good for the American economy, it may not be so great for some of these individual companies, right? If they can't push on large price increases to their customers because of competition, then that will limit their profitability. It will limit their earnings potential. Okay. So what does this mean for the stock market overall? Well, I think it means that we were in a world up until fairly recently that the only way you could get really great performance in the stock market is if you had a big overweight in tech and AI. And since essentially we started this program, we have had a big overweight in tech and AI. And the reason why our performance has been so good is because of that. Now, these concerns about, these three concerns that I mentioned, they're not going away. They're going to be with us. They're real. And therefore, to get great performance, I don't think the way to do it is to be so highly concentrated in tech. And we see it. We see it. And I've been sort of waiting and waiting, but it's clear that the rally in the stock market is broadening out. And it's broadening out to the users of AI. You're seeing the small cap sector starting to do really well. Industrials are doing very well. Value stocks are doing very well. All the users of AI are starting to actually outperform some of these AI companies. So the idea here is that we are in our own portfolios, we have transitioned to leaning more heavily into those who benefit from AI as opposed to just playing AI itself. And furthermore, I think that will be protected on the downside a bit more because anytime these fears that we just talked about, these three fears, cut through the market, it's the AI companies that suffer the most. Now, everything gets dragged down. You can't shield yourself from this downside volatility entirely, but by making the pivot that we made in our portfolio, we will shield ourselves more from these downturns. And also, I think we'll be able to capture a lot of the upside due to the benefits that AI will bring to the economy at large. So that's essentially the story. And if you look at corporate earnings, we're seeing corporate earnings for the fourth quarter, and they are gangbusters. The market has looked right through them, at least for most of this week, because of all the concerns we just talked about, right? The Kevin Warsh effect, and then these concerns associated with AI. The market, the investors have not focused on the tremendous earnings growth that we're seeing. And yeah, you can argue to some extent there's a lot of irrationality going on. But ultimately, at the end of the day, investors will refocus on the data, refocus on the strong economy that we're in, refocus on refocus on the great earnings that our companies are producing, and also focus on some really important geopolitical developments that we've been discussing in recent weeks. Hopefully, one that will culminate in terms of geopolitics will culminate with a major strike on Iran that either severely weakens the Iranian regime, and under a best case scenario, even could result at some point in a change in that regime, and that could liberate the Iranian people and help bring about a more peaceful Middle East and a more peaceful world. So, anyway, I kept it short and hopefully sweet, and let's see if anyone has any questions or comments.